The days just go by so fast. What I'm seeing right now, the the Federal Reserve, the chairman of the Fed, Jerome Powell, he he has done everything he could to give investors the green light. This is something we've been talking about a lot on this show. Be the boss of your money. That if the Fed wants to keep the rates that it controls, short-term rates, the federal funds rate, the discount rate at or near zero, and it wants to let inflation rise a little bit, and it's not overly concerned with rising longer-term rates, inflation is under control, you have a Goldilocks scenario. And that's a word we've been using quite a bit here on the show, Goldilocks. So stocks, which were kind of weak today, Dow was up a little bit, but NASDAQ, S&P were down a little bit. All of a sudden, things started to rip because the Fed came out and said, yeah, we're not raising rates. We're not doing anything. We're letting the market, the economy, we're letting the economy sizzle a little bit. If rates go up, if inflation goes up, that's okay. We could live with it. The Fed, you see, here's the key. The Fed sees any, you see, let me start again because I like the way this is going to sound. This is the key. The Fed sees any sign of inflation as transitory. That's the word they use. Transitory. It's temporary. So once the economy reopens and pent-up demand rushes in and the economy has a big spurt in GDP, the Federal Reserve expects that to moderate somewhat and get back to normal, which is consistently low inflation and slow growth, which keeps PE ratios high, stocks moving, bond yields down. It's a Goldilocks environment. I mean, in the meantime, we're expecting an earnings surge. Okay, so I kind of gave away what the whole show is about, but we've got to put this in perspective. So stick around. This day just went by so fast. They all do, okay? So I'm going to roll the intro, and we're going to get into some good things, what you need to do and what you need to do. And I put something out recently about bank stocks. We're going to talk about that too, because when you see long-term rates go up, short-term rates stay low, that means the yield curve gets steeper. The difference between the bigger the difference between short-term rates and long-term rates, the better that is for banks. Boom, here we go. Okay, welcome to my live stream. This is Be the Boss of Your Money. I really should call it your live stream because it's about you. I really don't want to just get here and talk about things. I want to make sure that we cover things that you want to know, that you want to learn. I'm going to do my job and bring you the important concepts, lessons, knowledge, and experience that you could benefit from to make you better with your money, to make you the boss of your money. I know that sounds maybe hokey. Oh, be the boss of your money. It's really about you taking control of your money, because how often in life does our money, our material things, our lack of financial education, that becomes the boss of us? We need to reverse that. So if you're watching right now in the live stream, I'd like to welcome you. If you have any questions, certainly ask me in the comments. Words of wisdom and words of encouragement are always appreciated here and Be the Boss of Your Money. I love to hear from you. That's the best part of this whole thing. And if you're watching this in the replay, welcome to you as well. It is a pleasure to have you here. Your time is very valuable. I know that, and I appreciate it greatly that you chose to spend some of it with me. So let's take a look. We've got a few people out there. Stephen Bonfa, attorney, LLM. You know what that means? he has a master's in taxation. So he's gone above and beyond, right? Right, Stephen? Hi there, buddy. I'm so glad you could join me. Thank you very much. We've got a few more out there. I see the comments coming in. So I am going to start pointing to those a little bit, but I want to get into the heart of the matter. All right. So I put out a LinkedIn post, and I also want to show you. I updated something, so I'm going to ask you for your opinion. I'm really happy with the way I did something today. I'm really happy with the way it came out. But my, are you guys all on LinkedIn? Because LinkedIn is like my number one go-to place. That's my number one social media. So I'm going to make my screen a little bigger. I'm going to show you what I did. Let me make this a little bit smaller. Okay, I'm going to do a quick screen share. Put myself up. Okay, I'm up in the corner. You see that? I put a new banner in, okay? Live stream host of Be the Boss of Your Money, financial advisor at Client for Strategy. The reason you're seeing this edit pencil is because you're looking at my profile view. You're looking at it through my, so I can make changes and all that. You wouldn't see this if you looked me up, that little pencil there. But these are the media outlets that I'm quoted in. There are some others, but these are the main ones. And here's my about profile, featured, and some of the stuff on here that I've posted about. And let's get to posts. But I'm a heavy user of LinkedIn. And if you're not, like, here I am right now on my live stream. I'm not going to play that because it'll kind of look weird. But I put this out here, okay? What's one way to destroy your potential to make money in the stock market over the long term? That's something we talk about a lot, because it's not just about investing. Anybody could invest. I mean, anybody could conceivably buy a stock, but not everybody could create an investment portfolio that's right for them. So I always like to ask, what good is an investment portfolio if you can't stick with it? Because the idea is time in the market as opposed to timing the market. You could have the greatest portfolio in the world, or all geared up for the best, biggest, craziest, largest, ginormous growth ever. But if you panic and sell out every time the stock market goes down because you think the world is coming to an end, like in the year 2000, like in the year 2007, like in the year 2020, you're always going to sell out, and then you're going to have to time things to get back in. Or if you sell out, then you're going to say, I still think we're going lower. I still think something political is going to knock the market down. I still think we have to retest the lows. I mean, the lows of 2020, there were people who sold and said, nah, we've got to have a retest to really know the bottom is in. By the way, if we did have a retest, those same investors would say we have to have a third retest to make sure that the bottom is in. What happens is people hesitate and they wait to invest. And when you wait to invest, not you specifically, I mean, people might think that they're waiting for a better time to invest, but what it really means is you just have less time to invest. And we all know that positive investment returns with lower volatility is really a function of time, of patience, not a function of timing, of bouncing in and out. I'm not against buying a stock or selling a stock. I'm into long-term investing, long-term holding of any position. I don't buy investments for short-term. I don't put, I have full discretion over my clients' investment accounts. I don't get into a stock unless I think we're going to be, let's say a 2 to 5 year hold. And some stocks, it's way, way longer than that. I've been in this industry for over 30 years. So that's like a really important point. Okay. So let me give you a little view of the inside here. I'll just move my tissue there. Okay. But this is just basically an inside view of what you see what you're seeing. This is how I do my thing every day. So I've got my, for example, I could do this. Okay. I could pipe in some music. All right. Pipe in some music, which I didn't do in the introduction, but I do enjoy doing that. Okay. We'll fade that out. This is my mixer. This is how all the sound comes out. And this is what makes me sound so delicious. Yes. I can't believe I just did that. I don't know. I don't know why I did that. Okay. And this is back to camera 1, camera 2, camera 1, 2, 1. I can't stop doing that. It's just something so satisfying about this. I'm going to stop. I'm going to really stop. Okay. Let's move my hand away. Let's take a look at the stock market. Let's take a look at today's action. Action-packed. Okay. Dow closed above 33,000 for the first time ever, and with good reason. The stocks that are in the Dow, including a number of, well, there's some tech companies like Apple and Microsoft, but there are companies like Disney, and there are companies, Honeywell. I mean, just it's really not an industrial index with companies like Johnson & Johnson, JP Morgan. These aren't really industrials. I would say the Dow is more just like a general market index, or maybe an all-American index. They should call it the all-American index. But Dow above 33,000. NASDAQ, which was down over 1% today, had a decent finish. Dow hit a new record today, and the S&P 500 hit a new record. We are very close to breaking 4,000 for the first time on the S&P 500. Gold, we've been talking about gold, how it never moves, but people are worried about inflation. I feel like today's a sea change for gold, because Powell says, hey, we're going to let inflation run hot. And if inflation runs hot, well, that's generally speaking, gold is an inflation hedge. So gold would go up. We'll take a look at Bitcoin, and we'll take a look at Bitcoin and the other crypto stuff. Oil off a touch, but still $64 a barrel. It's been doing well. And the 10-year Treasury hit a highest level in over a year and a half. You're going to hear that a lot every time the 10-year yield goes up. Oh, it's the highest in a year and a half. But I was asked for my thoughts of where I think the year could end, of where the 10-year yield could end 2021. And I said, I could see it at 2.5%. That's a little higher than consensus. But every week, consensus, which is I think too low, keeps raising forecasts for GDP, for inflation, for interest rates. Right now, people are agreeing with the Federal Reserve that whatever inflation we get this year, maybe early next year, will be transitory. There's not a lot of capacity constraints. That's the thing. Like, if we need more of anything, we could either mine it or manufacture it. So there's a lot of capacity, and that's one of the things that's keeping rates down. Okay, Dow climbs 189 to close above 33,000 for the first time as Fed sticks to its easy policy. Let's just take a look at crypto. Crypto is up 4%. Crypto is now viewed as a hedge against inflation, because if the dollar gets weaker and there's too many dollars, then you want to own crypto. This is how the thinking goes. I'm not saying you want to own crypto. I'm just saying that the buy thesis for Bitcoin is that as the dollar gets weaker, inflation goes up. Bitcoin is a inflation hedge, but on steroids. Like, gold doesn't move as quickly, not by a long shot, doesn't move nearly as quickly as Bitcoin. So let's take a look at some of the industrials that we've talked about. GE up 3.5%, Boeing up another $8 today. Oshkosh makes like fire engines, heavy duty trucks, cement trucks. It's not Oshkosh, the children's clothing brand. Okay, Oshkosh B'gosh. Caterpillar up a whopping 7. Textron makes is a defense company. They also make easy go-karts. They make a couple of things, but American Airlines, Grainger hit 400. That is a new all-time high on Grainger. That's for the people who get things done, right? And Southwest Airlines, a stock we've talked about here, all the airlines we've talked about because they're reopening plays up $1.23. Let's move on to the FANG stocks. Facebook, 284. What was it? 2 months ago, 3 months ago, the stock went from, 300 down to like the 240s, 250. People worried about, a Justice Department investigation. And then people started to realize, if Facebook was to break up, that could actually create a lot of value. But that's back to almost 285. Amazon up $43. It held that $3,000 mark. I mean, it dipped below for like a minute and then came right back. So it held. Netflix, Google off a touch, Microsoft a little, Apple off a little. Of these, Apple is over the last, I'd say 2 weeks or so, Apple's been the dead wood here. Not that you could call Apple dead wood, but just the last, very short term. The others have been doing all the lifting while Apple has been sucking wind. Reopening stocks, UAL, Marriott Hotels up $5. It just, when I look at these reopening plays, Royal Caribbean has gone from 19 to almost 100. Delta, Southwest, Norwegian Cruise, Planet Fitness. Cinemark Holdings is the only one that's off. Big deal, 20 cents. But reopening stocks doing fabulously well. Consumer discretionary led the way today, and these are the ETFs that track the major indexes of the major sectors of the economy. Consumer discretionary, industrials, building materials, including building materials, energy, financials. Those are the ones that you want to see move higher when there's belief that the economy is improving. So I think we've had enough of that. Let's get here. So we're going to get through this pretty quick. I think I'm almost done. And then I'm going to take a look at your comments. So, look, I'm not saying you go all out in stocks and just say, hey, you know what? This is Goldilocks. Mitch said it's Goldilocks. It's, the economy is not too hot. It's not too cold. It's just right. I do think the economy will run too hot, but the Fed says, we're not raising rates. We think, it's transitory. But when you get higher rates and lower rates stay low, bank stocks in particular do very well in that kind of environment. And I did a whole post about that and a short video, like 2 minutes, about bank stocks. I'll share that in the comments later after the live stream. Take a look at it, please. But if you want to see where there's potential in this kind of market, banks are still paying like 0.01% interest, but now they're making loans at higher interest rates. So their net interest margin keeps going up. It's remarkable. Okay, so let's see who else is out there. I'm not going to show every comment because it looks like some people are trying to tout stocks or cryptos by commenting. Like I'm going to show those comments and somehow they think it'll do something. I'm going to skip over those. So first, my audio engineer friend, Ron, welcome to our chat. Say hi and join the conversation. We always welcome your questions and comments. And if you're catching us on the replay, thanks for watching. Is that what I should have said? Maybe are you telling me that I need to improve my opening? I'm like, I don't know. I sometimes I think I should just say the same exact opening phrase every time, then roll the intro and then get into it. I probably should. It would make my life easier. Okay. Okay. So we're not getting into the crypto stuff, Rick. Rick, I see you out there, and you're a consistent watcher and subscriber. So I thank you for being out there. But I'm concerned about putting crypto. I didn't realize it was you, man. But I don't want to put cryptos or specific stocks or ETFs, et cetera, onto the screen. For starters, I do have some regulatory issues with that are just not in my control. And I don't want to be, I just don't want to be on the hook for the one who's pushing it. But you and I are, you could give me a call. Look, I'll give everyone my cell, 516-818-0338, 516-818-0338. Anyone can call me anytime. I might not get to your call immediately, but I will get back to you. Okay. So, so Rick, I know you like those cryptos, but I just feel I can't put them up here. Okay. Mr. No Chops, I know who you are. That's Ron. Ron, is that okay to say you're Mr. No Chops because you like jazz, but you got no chops? I was paying attention. Welcome to our chat community. Say hi. Okay, yep, I got you. I got you. Stephen, thank you very much. Steve Bonfa, attorney at law. You are doing great. Thank you very much. I appreciate it. I do my best. I have to say I do enjoy this stuff. I love doing it. All right. And Ron is still out there. And I know who that is. That's Ron. It's the same. So you're hitting me on all my social media. Okay. Oh, shucks. There you go. I gave you a little tout there, right? You deserve it. Gary, where do you see the 10-year rates going in the next several months? Well, I'm sure you heard it. I said I think we could actually see 2.5 by the end of the year. So the next couple of months, I mean, we're already in March, so there's only 9 months left, and it's going to go by pretty quick. I know, don't say that. We're not even starting our springtime yet, but at least it's getting darker later, right? By the way, did you guys know that the IRS extended the tax filing deadline to May 15th, so they give you an extra month? So I shared that on LinkedIn, but my phrase before that in the body of the social media post on LinkedIn was like, I'd be really happy if they could make daylight savings time permanent. But in the next couple of months, I see it bumping up 1.8, 1.9, 1.8 in that range. If you're thinking about refinancing and you're like waiting on the fence and you could still get a good deal, I would, it's up to you, I guess. But I do see the trend is up. All right. I think we've broken the back of the bull market for the last 30 some odd years of treasury yields going down, bonds going up. So that's my thought. Yep. LinkedIn, platform check. All platforms are up. Thunderbirds are go. All right. Getting dizzy. I know you're getting dizzy from these highs. I mean, there is so much rampant speculation going on, and I do see that. Look, everything. I speaking with somebody yesterday, and it's like, maybe look at value, look at other assets, undervalued stocks, value plays. The thing is, everything is keyed off of interest rates. Interest rates are still very low. So if everything is high because rates are still very low, that means there really are no values. There are just relative values. So yeah, growth might be expensive at 25 times earnings, let's say on the whole. But so that means value at 18 times earnings is cheap when value is typically under 10 times earnings. So it's all relative. This whole thing is about finding relative bargains, not absolute bargains. I hope that makes some sense. Yeah, baby. Bring out the Dow 30,000. Ooh, a bearish call, because we'd have to drop a little over 10% to see that. Steve, have to run. All right. Well, I'm glad you joined us, and maybe you're not watching now, but catch you soon. Okay. Oshkosh Bajosh used to be my nickname. Really? Oshkosh Bajosh used to be your nickname. All right. I'm glad you shared that with me. So now, if I ever call you that on Facebook, it'll be like our own little, inside thing. Okay. All right. Platform LinkedIn looping after returning for 10 minutes. I hope LinkedIn is working. I've been having a lot of trouble with going live on LinkedIn this whole week. I don't know if I'm the only one who's having that problem, but hopefully it's better. Okay. Thanks for watching. Thank you, Mr. No Chops. You need a catchphrase and a sidekick, like an Ed McMahon. Like if you compare you and me, like you're a lot bigger than me, Jay. So like I would be like the Johnny Carson, you'd be the Ed McMahon, and you'd be in the background, right? But I'm maybe. I know you didn't say that you'd be my sidekick. You're too important and too smart to be a sidekick. You're like the main you're the main show, right? You know, you are the main show. And thank you, Ron. And okay, Rick, I can't look into XRP because I just don't know enough about them. I finally got my mind wrapped around non-fungible tokens and Bitcoin and all that, and it's taking a while. Mother, yeah, rolling on the floor. And you have been watching Be the Boss of Your Money. Ron calls me Mitch Goldberg, MD, the money doctor. It's cute. Wonder if my compliance people would allow me to actually like make that official. But I don't want to be overly, you know, like arrogant or something. And I don't want to, I mean, it could come off a little douchey maybe. So I just have to be careful with that, right? And Rick is out there. LOL. Yes, man. LOL. Thank you. Thank you. It's quite a picture you got there, Rick. Yes, sir. Yes, sir. Yes. Yeah. And don't gamble with the bread money. That's an old expression. Like I haven't heard that. Are you from like Brooklyn or Queens? Because my family hails from Brooklyn, and that is an expression that they use, and I haven't heard that in a very, very long time. So you're just like bringing back so many memories. It's crazy. All right, I'm going to end this show. I'm feeling kind of goofy, but I'm feeling good. And thank you so much for joining me. I will be back tomorrow, and I'd like to wish you a very healthy good night. Speak to you soon.